Right now, something extremely unusual is unfolding in the global gold market, and it's happening faster than most investors can process. In the span of just a few hours, gold collapsed nearly $200, plunging from around $5,250 to nearly $5,050, triggering waves of panic across futures markets and forcing leveraged traders to liquidate billions in positions. But just as quickly as the panic began, the market reversed direction. Buyers flooded in, short sellers scrambled to close positions, and gold surged back toward $5,300, creating one of the most violent intraday swings the precious metals market has seen in years. When a market as large and historically stable as gold starts moving this violently in such a short period of time, it sends a signal that something deeper is happening beneath the surface. This isn't simply normal volatility or random speculation. These kinds of moves usually happen when several forces collide at once: leverage in derivatives markets, liquidity stress, institutional repositioning, and sudden changes in global macro expectations. As a financial analyst, the most important thing is not just to focus on the price movement itself, but to understand why it happened and what it might be telling us about the broader financial system. Because gold is not just another commodity, it sits at the center of the global monetary system as a hedge against inflation, currency instability, and geopolitical uncertainty. When gold begins moving this violently, it often reflects deeper tensions building within global markets, and that's exactly what makes this event so important. What happened today may look like chaos on the surface, but underneath it may be revealing a much larger shift in how investors are positioning themselves for the next phase of the global economic cycle. At first glance, a sudden swing in gold prices might seem like something that only affects traders or commodity investors, but the reality is that movements in the gold market often reflect much larger forces that ultimately impact everyone. From households and small businesses to governments and financial institutions, gold has historically served as one of the most important indicators of global financial stability. When investors become uncertain about inflation, currency values, interest rates, or geopolitical risks, they often turn to gold as a safe store of value. That means sudden volatility in gold can be a signal that confidence in the broader financial system is beginning to shift. For ordinary people, that shift can eventually show up in very real ways, through rising inflation, currency instability, higher borrowing costs, or sudden changes in financial markets. For businesses, particularly those involved in manufacturing, energy, or international trade, fluctuations in gold prices can also affect commodity costs, hedging strategies, and long-term financial planning. Central banks themselves pay extremely close attention to gold because it represents a strategic reserve asset used to stabilize national currencies and financial systems. Over the last several years, central banks around the world have been accumulating gold at one of the fastest rates seen in modern history. That tells us something important. Policymakers are increasingly concerned about long-term monetary stability. So when we see the gold market suddenly plunge and then rebound violently within hours, it suggests that powerful financial forces are interacting beneath the surface, forces tied to leverage, liquidity, and global macroeconomic expectations. These events may appear technical on the surface, but they often foreshadow deeper changes in the economic environment. Understanding what is happening in gold today may help investors, businesses, and policymakers prepare for the financial conditions that could emerge tomorrow. The sequence of events that triggered this dramatic move began during a period of unusually heavy trading activity in the gold futures market. At the start of the session, gold was trading relatively stable around $5,250 per ounce, with market participants waiting for new macroeconomic signals. But within a short window of time, a surge of selling pressure suddenly hit the market. Large sell orders began appearing in futures exchanges, particularly in highly leveraged trading positions. As prices started to move lower, automated trading systems and algorithmic strategies quickly detected the downward momentum. These systems are programmed to respond to volatility and technical levels, and once certain price thresholds were broken, additional selling orders were automatically triggered. This created what traders often call a liquidity cascade, where each wave of selling pushes the price lower and forces more participants to exit their positions. As gold dropped through key technical levels around $5,200, margin calls began hitting traders who were holding leveraged long positions. When leverage is involved, even relatively small price movements can trigger forced liquidations. Those liquidations accelerate the downward move because traders must sell contracts immediately to meet margin requirements. Within minutes, the selling intensified and gold rapidly plunged to around $5,050, wiping out billions of dollars in leveraged positions across derivatives markets. But the selling pressure eventually reached a point where the market became oversold. At those lower price levels, institutional investors and physical buyers began stepping in. Short sellers who had bet on lower prices suddenly found themselves exposed to a reversal. As buying pressure increased, many of those traders rushed to cover their short positions, which added even more upward momentum. The result was a sharp rebound that sent gold soaring back toward $5,300, completing one of the most dramatic intraday reversals the market has experienced in recent years. To understand why this kind of extreme price movement happens, it's important to look at how the modern gold market actually functions. Most people assume that gold prices are determined primarily by physical buying and selling of the metal itself. In reality, the majority of price discovery occurs in futures markets, where traders buy and sell contracts representing gold rather than the physical metal. These futures contracts allow investors to control large positions using leverage. A single gold futures contract can represent 100 ounces of gold, which means traders can gain exposure to large amounts of gold with relatively small amounts of capital. While leverage allows traders to amplify potential gains, it also increases the risk of rapid losses. When prices move unexpectedly, leveraged positions can quickly become unstable. This creates a chain reaction in which margin calls force traders to liquidate positions to cover their losses. The event we just saw appears to be a classic example of this dynamic. A large initial wave of selling likely triggered technical breakdowns in price charts, which activated automated trading systems and stop-loss orders. As the price fell further, leveraged traders began receiving margin calls, forcing them to sell contracts immediately. This accelerated the decline and pushed prices lower in a short period of time. But once those leveraged positions were flushed out of the system, the underlying demand for gold remained intact. Institutional buyers, hedge funds, and physical market participants viewed the sudden drop as a buying opportunity. That buying pressure reversed the trend and triggered a short squeeze, where traders betting on falling prices were forced to buy contracts to exit their positions. The combination of forced liquidation followed by aggressive dip buying created the dramatic whipsaw we witnessed. While these events often appear as numbers and charts on trading screens, the consequences of such volatility extend far beyond the futures exchanges. When markets move violently within hours, real financial damage occurs across a wide range of participants. Highly leveraged traders can see entire portfolios wiped out during sudden price collapses. Many of these traders operate with tight margin requirements, meaning a rapid decline in price can erase their equity almost instantly. In the case of this gold crash, billions of dollars in leveraged positions were likely liquidated as the market plunged toward $5,050. But the impact is not limited to speculative traders. Businesses that rely on gold hedging strategies such as jewelry manufacturers, electronics companies, and precious metals dealers can also face unexpected financial pressure during extreme price swings. Companies often use futures contracts to stabilize costs and manage price risk. When volatility spikes, those hedging positions can become difficult to maintain, forcing companies to adjust contracts or absorb losses. Even large financial institutions can experience stress when markets move violently, especially if they hold complex derivatives tied to gold prices. Banks, trading firms, and hedge funds all maintain exposure to commodities through various financial instruments. When volatility surges, risk management systems across the financial industry are suddenly tested. Liquidity can disappear quickly as market participants hesitate to take positions during uncertain conditions. Beyond financial institutions, extreme commodity volatility can eventually ripple into broader economic sectors. If gold prices continue to swing dramatically, it can influence investor sentiment across other asset classes, including currencies, equities, and bonds. In this way, what begins as a sharp move in a single market can quickly spread through the global financial system, affecting businesses, investors, and financial institutions worldwide. One of the key factors amplifying volatility in the gold market today is the broader environment of financial uncertainty surrounding global monetary policy. Central banks, particularly in major economies, have spent years navigating the difficult balance between controlling inflation and maintaining economic stability. Interest rates have moved sharply in recent cycles, and markets are constantly trying to anticipate what policymakers will do next. These expectations can create enormous swings in investor positioning. Gold is particularly sensitive to interest rate dynamics because it does not generate yield like bonds or savings accounts. When interest rates rise, some investors shift capital toward yield-producing assets, which can temporarily pressure gold prices. However, if markets begin to believe that central banks will eventually lower rates to support economic growth, gold often regains momentum as investors reposition for future inflation or currency weakness. This constant tug-of-war between inflation fears and monetary tightening has created an environment where markets can react extremely quickly to new data or expectations. Even small shifts in economic indicators such as inflation reports, employment data, or central bank statements can trigger large changes in trading activity. In this context, leveraged traders in the gold market are often positioned aggressively based on short-term macroeconomic expectations. When those expectations suddenly change, positions can unwind rapidly. That appears to be part of what contributed to the dramatic move we just witnessed. As investors reassessed macro conditions and interest rate expectations, leveraged futures positions became vulnerable. Once the selling began, the cascade effect accelerated the decline before the market stabilized again. In many ways, this volatility reflects the broader uncertainty surrounding the future direction of global monetary policy. Another major force shaping the gold market right now is the growing tension within the global currency system. Over the past decade, many countries have become increasingly concerned about their dependence on major reserve currencies, particularly the US dollar. This has led to a noticeable shift in central bank behavior. Countries around the world have been increasing their gold reserves as part of a strategy to diversify national assets and reduce exposure to currency fluctuations. Central bank gold purchases have reached some of the highest levels seen in modern financial history. These purchases are not short-term speculative trades. They represent long-term strategic decisions by governments seeking financial stability in an uncertain geopolitical environment. At the same time, global trade patterns are evolving. Some nations are exploring alternative payment systems and bilateral trade agreements that reduce reliance on traditional financial channels. While these changes are gradual, they contribute to a broader sense of transition within the international monetary system. For investors, this creates a complex landscape. On one hand, traditional financial markets remain deeply interconnected and heavily influenced by central bank policies. On the other hand, geopolitical shifts and currency diversification efforts are gradually reshaping how global reserves are managed. Gold sits at the center of this transformation. It is one of the few assets that carries no counterparty risk and can serve as a neutral reserve asset across different economic systems. When markets experience sudden volatility, like the move we just witnessed, it often reflects the intersection of these larger structural forces. The gold market is not simply reacting to short-term trading activity, it is also responding to long-term changes in how nations manage wealth and financial security. Events like this sudden gold whipsaw matter not just for traders or investors, but for national economies as well. Governments hold significant gold reserves as part of their official financial assets. These reserves play an important role in supporting confidence in national currencies and providing a financial buffer during periods of economic stress. When gold markets become volatile, policymakers watch closely because price movements can influence perceptions of financial stability. A sharp rise in gold prices often signals growing concerns about inflation, currency weakness, or geopolitical uncertainty. Conversely, sudden declines can reflect shifts in liquidity conditions or investor sentiment. The recent collapse and rebound illustrates how fragile financial markets can become when leverage and macroeconomic uncertainty combine. National economies are deeply interconnected through trade, financial markets, and capital flows. If major asset markets experience sustained volatility, it can affect investment decisions, currency values, and borrowing costs around the world. For countries with large gold reserves, price movements can also influence the value of national balance sheets. Central banks frequently adjust reserve strategies based on market conditions, and sudden shifts in commodity markets can shape those decisions. In addition, gold plays an indirect role in shaping broader market psychology. When investors observe dramatic moves in gold, they often interpret them as signals about inflation risks, financial stress, or monetary policy shifts. That perception alone can influence capital flows between different asset classes. For this reason, policymakers, economists, and financial institutions all monitor gold markets carefully. What may appear as a short-term trading event can sometimes reveal deeper changes in how markets perceive economic risk and stability. The dramatic collapse and rebound in gold prices within just a few hours should serve as an important reminder about the complexity of modern financial markets. Today's markets are driven not only by traditional supply and demand, but also by algorithmic trading, leveraged derivatives, global capital flows, and shifting macroeconomic expectations. These forces can interact in unpredictable ways, producing sudden and sometimes extreme price movements. The gold market, despite its reputation as a stable store of value, is not immune to these dynamics. In fact, because gold sits at the intersection of currency markets, commodities trading, and macroeconomic expectations, it often becomes a focal point during periods of financial transition. The whipsaw we just witnessed may ultimately be remembered as a signal that the global financial system is entering a more volatile phase. Rising geopolitical tensions, evolving monetary policies, and structural changes in global trade are all contributing to a shifting economic landscape. Investors are increasingly trying to position themselves for a future that looks very different from the financial environment of the past decade. In that context, gold remains one of the most closely watched assets in the world. Its movements often reflect deeper concerns about inflation, currency stability, and systemic risk. While short-term price swings may appear chaotic, they frequently reveal important information about underlying market forces. For investors and observers alike, the key lesson is to look beyond the immediate volatility and focus on the structural trends shaping the market. Because when gold begins moving this violently, it is often telling us that the global financial system is undergoing significant change, and those changes may only be beginning.